Okay, hi, welcome listeners. It's James Harkness here from Altus Group, where I'm a strategic account partner. Hey, we've got 1,300 people registered for today's event. We've got participants from the US, Canada, Mexico, Colombia, Japan, Singapore. Frankly, it's a truly multinational crowd. So thanks everyone for joining. And really, we hope here at Altus that you come away from this discussion with a few high conviction insights. And also please continue that discussion. We want to make sure that valuations are being talked about, fund structures. It's so important to everyone in our industry. And a warm welcome to our panelists. So happy to have Margaret McKnight from Stepstone, Chris Lennon from North Point Development, and Adam Vanny all the way out from San Diego with Fairfield Residential. Yeah, I'd recommend looking at their LinkedIn profiles, tremendous amount of experience. And as we're asking questions, or the first questions to the panelists, I'll be sure to ask them to introduce themselves, get a little bit of a background as well. I have 4 themes for today's discussion. We want to talk a little bit about current valuations, like get an idea of the tone of the market. We're going to talk a little bit about fund structures and investors' appetites for those fund structures. And of course, we always like looking out into the future, see what the panelists think of the market for the remainder of the year and into 2024. And then at the end, I just always love hearing about the firms that our panelists work at and going to ask some impact questions. All this in 45 minutes. So I think, we got to jump in here. I will note that today's session is being recorded. So we'll follow up with a link that you can use to revisit any points or share it with friends and family. And then also, if you have questions, don't be afraid to enter them into the chat. We'll adjudicate those questions and try to get to them during the session. If we don't, someone will follow up and make sure that your question is being addressed. So Margaret, welcome. I just wanted to start off with you, and can you share your reaction to kind of like Q2 results and some of the numbers that are being published and maybe kind of your perception of valuations across all the sectors in the US today?
Yes, thank you for having us. I'm the head of portfolio solutions for Stepstone Real Estate. We work across about 185 billion of client assets. We deployed 18 billion to primary funds last year on a discretionary and advisory basis, and 2 billion to secondaries and co-investments. So we're actively underwriting and talking to leading LPs and GPs in the marketplace. And I feel like I'm a little bit the bearer of bad tidings, particularly considering that you're kindly hosting this and have us here. But I have to say there was real disappointment in the Odyssey results. We keep a running chart that's a leading page we present to our clients that is meant to represent peak to trough. And so it's kind of 18 months year to date, or well, period to date. And
sure.
The public markets are down about 22%. The Green Street CPPI is down about 22%, and that is reflecting of actual and in-process trades, which predominantly represent high quality multifamily and industrial down, both of them down over 22%. And that 18-month period has the Odyssey down 4%, and we saw less than 4% less quarter on an appreciation basis. Burgess is not out yet. It's the best non-core. And it was actually up, well, it was down 0.3 for the first quarter. So the numbers do not look right, and they do not look reliable, and it's a real pain point because we can't deploy money. It puts clients in an over-allocated position, and it exacerbates the bid-ask spread if sellers think their basis is something that it's not.
So those results kind of reflecting on the, not paralysis of the market, but just investors maybe hesitating or questioning their asset allocation. And I think it's good insight that you bring from Stepstone, right? Because you're looking at all kind of different primary, secondary entries to the market. So Chris, in our oh, sorry, go ahead, Margaret.
The market's not paralyzed. Trading volume is down, but it's definitely still happening. You talk to the leading brokers. Market pricing is kind of treasury plus 150 to 200 bips, which is, 600 basis points plus, which is not where the Odyssey numbers are.
Well, yeah, and you think of that as like just a rough cap rate, right? Treasury plus to a bit. I mean, that's the cap rate where markets are looking at. So Chris, you mentioned in your, we were talking before getting prepared for this, that you thought over the longer term, some of the valuations at North Point maybe were not as volatile, and, just wanted to get your thoughts on it, because I thought it was kind of a, an interesting view.
Yeah, absolutely. And so whereas Margaret's talking about the whole market broadly, first of all, we only do industrial, a little bit of multifamily, but for purposes of this discussion, we'll keep it limited to industrial. We also really only do newer build, really, and have built maybe 20 billion over the last decade or so in the US. And we lean a little bit Midwest, and perhaps that's what you're referring to, James. So perhaps our markets don't tend to get to those really low cap rates in general. And then I think what we had described is that we also don't have any open-end fund product or a lot of people who are as interested in it as we generally have basically separate accounts and some very high net worth folks who we do build to hold for. So a lot less sensitivities, a lot less dog in the hunt. I will say that last year we did certainly recognize, maybe the second half of last year, we fairly quickly did write up maybe 50 or 75 basis points of, kind of increased cap rates. But this year it's been steady as she goes. I mean, maybe one other dimension, we lean a little bit manufacturing, and with the CHIPS Act and the IRA, it's actually, perhaps there's going to be a new ecosystem. So in addition to just getting product to consumers, there's also maybe a resurgence of some of that manufacturing. So it tends to be where we've been participating. So maybe that's bolstering it as well. But you're right. Basically year to date, we've been at a plateau. So we certainly don't know the future any more than anyone else. But at the moment, it's been steady for at least for our little niche.
Yeah, and the IRA you referred to as the Inflation Reduction Act, and I think you also had a chart showing kind of some of the impetus of manufacturers to reshore, and maybe that's kind of taking the industrial equation just out of pure warehousing, but actually folks looking for manufacturing space. So I thought that was an interesting comment as well. And so Adam, tell us a little bit about Fairfield, and I think we're just pulling up that chart, but we can skip it, Hillary, in the background there. So Adam, you are residential focused. Tell us a little bit yourself about Fairfield and maybe any surprises that you saw in valuations return for where we're at in Q2. Please.
Yeah, sure. So Fairfield is strictly multifamily. We're an investment company. We do both development and acquisition. So we do develop to core, merchant build, and then on the acquisition side, core plus, value add, and affordable housing. So I'm the senior portfolio manager for our Core Plus series, and I oversee kind of the analyst group that does evaluations and forecasting for all of these different funds and joint accounts, separate accounts, open-end and closed-end funds. And so from I kind of agree with both what Margaret and Chris said to a degree is what is the real number, and are valuations really moving still? I do think that maybe values have been fairly flat this year, but I think that's different than the valuation that we're getting, as Margaret was pointing out. What we did last year internally was during Q3, Q4, as we saw a huge run up in rates. It did have a direct impact to value. So whether we were getting it appraised or not, we wrote our portfolios down. Some of our closed-end funds have fee structures based on GRE or NAV. So we have fiduciary responsibilities to try to be more in line with where we think pricing is, to make sure we're not overinflating our numbers. But I agree that there's some kinds of a disconnect between what the cap rates of an appraisal is getting versus what we're seeing in the marketplace. And so from our appraisals this quarter, because we wrote those assets down and increased our cap rates Q3, Q4, appraisals this quarter actually were flat to our valuations internally. So they're getting closer to where we were. But where we saw the disconnect still was a few of the assets we have on the market to sell, usually due to fund life expiring or debt maturity. Those values are still substantially below where appraisals and BOVs are coming in, because debt rates are continuing to move, and in a closed-end fund, especially, most buyers have debt. So the minute the debt changes, the values change for what they can change, unless they're changing what their underwriting standards are, which we really haven't seen yet. So there's continued pressure as rates are going up on cap rates, and I agree that I don't think they're totally reflective in the Odyssey market, but we're seeing them sort of real time as that bid-ask spread is very prevalent still.
Yeah, that's interesting and good feedback. And maybe we'll take this to and Margaret or Chris, any other comments on that, just around kind of the reaction? It's kind of, to summarize, it really does sound like we have, say from Margaret's lens, this investor allocation view is kind of not sure what's going on. And then Adam, from your portfolio management perspective, you're kind of like, well, what's the difference between what the acquisition price could be versus what the valuation is? And then Chris, you guys are just focused really on kind of your target area. And so values haven't really been necessarily super volatile, but I think if anything, listeners can kind of take from this is that there is a need for discussions, there is a need for data and looking at as many different metrics as you can. And so maybe just put up a poll question for the audience. Please participate. It's only going to be up for like 30 seconds, but the question is, which fund structure do you think is the most popular in the current market environment? So fill this out, and maybe Adam, over to you. You mentioned some of the structures there at Fairfield. Do you see a preference to a certain type of fund structure in this environment?
Well, I think the biggest piece is it depends on the type of investor and it depends on what the investment strategy is. We see, the one thing I can say is consistent is investors generally have an opinion about what they want to invest in and how much they want to invest in a market like this. For development assets especially, we see kind of separate accounts and joint ventures where the LPs have discretion as a very favorable environment, because we're seeing investors who are actually increasing the return requirements for development deals based on the economic uncertainty, interest rates, cap rates, et cetera. But on the other hand, closed-end funds for more acquisitions, in order to be competitive and nimble in a competitive environment, the closed-end funds are still attractive investments for the long-term investor who's already in the account, because they don't have some of the liquidity issues that the open-end fund could potentially have. So they're really looking at the long-term environment. But as Margaret said, kind of the denominator effect is if funds aren't writing things down in the right way in accordance with where the stock market is going, are investors then being over allocated to real estate, which kind of hurts where are they going to put their money in the future.
Okay, interesting. And just seeing these results pop up right now, it looks like the audience is fairly mixed, to be honest. There's not a kind of sway one way or the other, but I think maybe I'll take from that is that having the right partner to work with is super important, and whatever fund structure is appropriate for how you're investing in private equity real estate or public real estate. So Margaret, you mentioned talking to your clients, and what are you discussing with them other than your concern with this spread of valuations versus maybe actual value? So do you talk more about fund performance? Is it the valuations? Is it the capital markets?
So for us, fund structure is really a strategic element, and we work with large institutional investors. They don't use non-traded REITs. They're much too expensive. The largest ones with the most sophisticated staffs can do the joint ventures and the separate accounts, and they do. And many of our clients, including the preponderance of US pension funds, use funds. We have non-US clients that are queued up to enter US core plus open-ended funds, and they're not moving, and we're telling them not to move because they're catching a falling knife. We are starting to see for the funds that have adjusted their valuations more that we're getting to a bid-ask spread that works. So we're seriously starting to look at secondaries and maybe being able to deploy that money, beginning towards the end of the year. For the closed-ended funds, the valuation is so opaque right now. The focus is really more on the opportunity ahead. And so again, there's frustration because of the valuations. The denominator effect is actually self-correcting because the stock market's coming back. But sales are down, so people with big closed-ended non-core portfolios aren't getting the money back to recommit and are just concerned. And on the other hand, we're doing our job to point out that there is a tremendous amount of opportunity in the market and a lot of stress on buyers, which we can talk more, on sellers, which should lead to a fabulous opportunity for recapitalizations and non-core buys. And this is not the global financial crisis. Most senior folks actually see that opportunity and want to pursue it. So trying to figure out with whom and when's it going to break and how is really where a lot of our conversations are happening.
Yeah, so that's fascinating because you have the international perspective, you have the domestic investor perspective, you have denominator effect, which really for folks that are out there, a multi-asset class portfolio, maybe the equity markets improve, so there's maybe more of an allocation to privates or alternatives. And so that's very interesting. I mean, I think, in this industry, folks have to remember there are cycles, right? Like, and we do see ups and downs, and curious that there are some folks that are waiting to see. And I noted on the Wall Street Journal today, they had an article about investors actually looking at opportunities, which, you really hadn't seen that kind of a positive headline out of one of the larger newspapers. So who knows, maybe the tide is turning. And, just kind of continuing on this theme for Chris, what about shift in appetite from your, call them clients, but investors around fund structures? Any trends that you can elaborate on?
Well, look, I think Adam and Margaret nailed it. I mean, in general, there's sort of a preferred habitat theory, right? So people kind of like what they like, and a few people do both and maybe go between them, but I don't know that there's a theme necessarily. Certainly what we do have some investors who are interested in open-ended fund structures, but have cautioned us to just maybe wait a little bit. This might not be the very best time to start the open-ended fund structures. So maybe not surprising based on what, Adam and Margaret have said. So no, I don't think I'd have anything to add other than what these two have said already.
Yeah, okay. No, that sounds good. So let's kind of pivot over to our second theme, which is around valuations and comparables of those valuations. Margaret, there's lots of different ways to do an appraisal. And so, but the market the tone has been around, well, there's not a lot of comparables, but just, questioning, for you, how do we kind of move forward? Is it like a capital markets catalyst, or is it something else where people just are okay with, higher interest rates and the valuation models adjusting accordingly to what their maybe end returns are going to look like?
Having spent a multi-decade career in an industry where there isn't a lot of clarity, what I've learned is to use all the tools I have, and at different times, some of them are more useful than others. We, as I've mentioned, are underwriting secondaries and co-investments every single day. There is a real buying opportunity that, we're sifting through a lot. We are not looking at comparable transactions are not getting ignored. But I just talked to a colleague of mine who's a former CFO, and he said, we're not buying the building around the corner that just traded. We're buying an income stream now. And we really need to lean into the DCFs. And the investment committee conversation is, what are the odds of achieving certain rental outcomes and rental rate growth assumptions and exit caps? And the exit cap is a big conversation we're having with a lot of GPs, because we're trying to figure out, what is the future of interest rates? It's not that hard to look at the relationships between what you're trading and the treasuries and the spreads. So real input is, what's going to happen with interest rates. So there's a ton of discussion around that by the more sophisticated buyers in the industry. We can't wait for comp transactions to come around, because by then we will have missed a spectacular, once in a 20-year buying opportunity.
Yeah, that's right. And I think there's probably for folks that have been in this year a while, they remember when those times existed, and then the subsequent, call it time-weighted returns that you could generate. And so do you find you're getting more questions around how the assets are being managed? So I know you're kind of looking at portfolio and allocation level, but is that kind of bubbling up? Because in my view, with, the income return being a super big part of that kind of return, you've got your capital appreciation, you got your income return, like, does that put more attention on that? And are you getting more types of questions from your investors around stuff that they maybe wouldn't talk about a couple of years ago?
I think successfully have guided our clients to invest with high quality managers who are, doing the best they can in an environment where leasing's a little softer and expenses are a little higher. Not to say they're, that is just a bar we expect. It's like almost table stakes to manage it well. It's more like, certainly for the open-ended funds, what's in your portfolios for everybody. It's like, what's the impact of the fact that borrowing rates are twice as high? Therefore, on paper, any refinancing you do is proceeds are half as much. When are your maturity dates? And How much office do you have in your portfolio? Because there's so many headlines around office, and people from outside the industry that look at real estate look at a line called commercial real estate, which includes office and retail. So they're telling us that, you know, retail is completely falling apart too. And I'm like, wait, no, retail's actually the blueprint by which office, we think, is going to reconcile. And it's going to take the 10 or 15 years, the same way it did for retail, but retail is just fine, thank you. So we are starting to have more pressure on us to really communicate the office exposure, which is challenged just, you know, across the board, even if you have great office.
Okay, so that's important. So like to summarize, I think the investor really focus on that income stream and what that income streams and the liability matching they might need to do with the rest of the types of investment products they own, like bonds, stocks, et cetera. So that's a very good insight for sure. And Adam, you mentioned, you know, your portfolio, you know, you're active, maybe not as hyperactive as you maybe were previously, but you know, in your sector, residential, you know, having more kind of comparables and other data points, is that helping you, or do you kind of create your own data? What's
Well, I should say, rather than active, how about trying to be active? We do have a lot of dry powder. We are trying to find investments, but we have not changed our return requirements. And in fact, if anything, we're almost increasing the return requirements based on the economic uncertainty and where rates are going. So we're bidding on everything that comes out to the market that we feel is a potential attractive acquisition, whether it's 4+ affordable, value add, et cetera. But what we're finding is, of course, that bid-ask spread is still really, really there. And where it was a couple of years ago, you could buy a 4 cap with 3% interest rate. Well, a 4.5 cap with 6% interest rate, not the same metrics. You don't get there. So this is where we're having to have those conversations. Is we can't buy 4 caps or 4.25 caps because it doesn't fit our investment thesis. So we're having to look at other ways. So transactional volume wise, this is the slowest, least amount of transactions we've had. I've been here 18 years, and it's aside from the GFC, I think when everybody kind of put pencils down for a while, it's been slow.
right?
But I think that we're going to get there. So we're utilizing to try to get to valuations. What are we bidding? What are other people bidding for the same assets? In some cases, somebody's willing to pay more, but we can still get a better gauge of what they're trying to do. As we know, a lot of those deals are not transacting, but it's so, you know, a lot of the sellers out there, the bids come in, they're disappointed, and so they go back to their drawing table and say, should we put more equity to keep it going, or what's that perspective? So they're not always transactions that appraisers can rely on, but we're trying to put out just all of our discussions of what we're bidding on, discussions with brokers or BOVs to try to get to a more realistic perspective of where we think rates are based on sort of our underwriting. Kind of what Margaret's saying, that the DCF model, which is for us, you know, kind of looking at the IRR of that 5 or 7, 10-year hold.
Yeah, and maybe we'll see more DCF type valuations in residential, which maybe hasn't necessarily always been the first tool to use. What was that other acronym you just used to describe? It was like RSVs or something like that in your valuations or your comparables.
The BOVs?
Yeah, BOVs. Yeah. What does that stand for?
So broker opinion of value. So we're talking to all the brokers out there, trying to see what they think the asset's worth, and what underwriting are they using to be able to justify that. So we can see the interest rate that they're putting in to get to their valuation, and that helps give us a little bit more detail into, you know, how they're arriving at a value.
Right. And Chris, over at North Point, your valuation models, like rates, we obviously know accelerated change very quickly, but have your models and your convictions kind of stayed the same, or have they changed?
I think so. And listening to what Adam and Margaret are saying, I mean, we would certainly agree with some of what we've heard here. I mean, it may be just an interesting observation too, between the multiple tools and the tool chest, as Margaret mentions, you know, transactions dry up, so you have fewer comps in general, and maybe the ones you have perhaps have more of a story than ever they have. So you have to really try to figure out how useful they might be, either on a good or a bad side, actually. And then at the same time, the reason transactions are slowing down is because maybe people are a little uncertain of the future, or perhaps add in some interest rates. So you have sort of the two tools are each kind of on the fritz a little bit, perhaps, which perhaps leads to inertia, is my guess, which is maybe some of the frustration that I think, Margaret's hearing about. So look, in our case, again, I think I've already covered ours, where we're a little bit different. We certainly have done some acquisitions, and 12 years ago we did a little acquisitions, but I think we found that we believe that we could add a couple hundred basis points through, accumulating by the building blocks and building. So, that additional kind of yield is something we targeted. And so we do a lot less really of the acquisitions, or have done. And so I think we're maybe a little bit less in the fray as perhaps Adam might be. We're certainly having deals that maybe are perhaps a little skinnier, but not necessarily, because there's so much fewer new builds. I mean, I think we're actually somewhat constructive on the fact that we'll deliver and there'll be only a certain amount of new builds. So we're all suffering from different dimensions, but I think ours is maybe just a bit different lens than the others.
Yeah, you would have had to contend with land prices changing and the value of land changing drastically, though, right? For the amount of acreage that you would need to put up one of your warehouses, I'm assuming.
It is a good point. So the good news is that, we're not so sure. Interestingly, we've heard talk of there's going to be a lot of distress in real estate. There may be, but you just sort of have to think, for distress to happen, you kind of have to have, precarious hands, people who kind of, need to trade. I'll be curious to see if it happens the way we all, maybe in office it does. The land sellers, frankly, don't have to sell for the most part, right? And so what has been removed is the people who are trying to kind of intermediate themselves or interject themselves and perhaps buy up land in the view that they'd sell it or do some entitlement. So there's been a little bit of the pure froth coming out of that input, which you're right is a very important input to the process, as is steel and as is, the trade. But I think that there has been a reduction in the froth of land prices, but to sort of suggest that there is a great distress going on in land prices perhaps is not the best characterization.
Perfect. Okay. Well, hey, let's use this kind of transition to put up another poll question. And this one is really, how often do you value or acquire values on your assets? So hopefully, listeners, you can get a sense that Altus, as a valuation and valuation management service provider, we're keen on knowing kind of what kind of the opinion is out there. So I know I did this to you before, Adam, and asked you a question as the poll results were being put up, but maybe just while we wait for participants to select their choice, do you, Adam at Fairfield, do you see more frequent valuation requests? Like, do you think that just like the technologies and the systems have evolved that we'll be seeing kind of more and more evaluations more frequently?
Yeah, I do think that we're going to continue to see technology evolve to get more data points for people, especially when we're in markets like we just have that are very volatile. Assets are going down, or conversely, as a year ago, values are going up. Investors, as we can very much see, want to make sure if something is being a fair value fund, that it's being fair valued appropriately. And so that's where, we internally wrote assets down if they weren't necessarily being appraised. A lot of our closed-end funds will generally do appraisals once a year, and internally each quarter you're kind of looking at the valuations and are those still reasonable. Real estate, for the most part, historically doesn't move very fast, but when debt markets are extremely volatile, that's creating more and more volatility on the asset valuation side. So I do think if you're not internally doing more regular appraisals or internal valuations, maybe quarterly, you're going to start to get questions, and especially in markets where the market's clearly moving, I think investment firms are going to have to be more on top of it.
Yeah, well, that's right, and have to adjust and kind of be prepared. And maybe Adam, have you also been changing your reporting up to investors and to some of the LPs and some of the or is that kind of getting ahead of some of their issues around how often values are going?
What we're finding is that especially sophisticated investors are asking a lot more detailed questions. They want to know what the average cap rates are, and of course, cap rate is a very kind of generic term, and depending on what market, what type of asset, how you're doing the NOI. But they want to kind of see where our cap rates are in comparison with where our exit cap rates are, so they can get a better gauge of not only is our current valuation reasonable, or is it maybe overstated based on their own knowledge of the markets, but also what is our forward outlook going and what's our risk profile for the future. So we are seeing more and more investor questions in markets like this that traditionally, I said, historically, real estate doesn't really move very fast. And so in a normal environment, it's kind of been okay, but right now it's not. And so we are kind of being, I mean, we always try to be transparent, but we're trying to be more forthright with what we're showing them and what we're telling them, and kind of giving them that perspective so they know where we're sitting today, where we expect things to go, so for their comfort level and ours.
And on our view at Altus, I mean, we see a ton of engagements where, you know, there's just a need for more detail. I mean, we, you know, even in some cases, they want the chart of accounts for the actual property and they want to roll up and do analysis. And Margaret, I know you have maybe some thoughts too on that investor perspective, but what's, you know, your view on more frequent valuations? Is it investor pressure? Is it just like you said, there's table stakes for the type of managers to whom you want to introduce or recommend that your clients invest with? So is there just like everything's improving in that way, or what are your thoughts?
I would say right now the emphasis is getting a quality quarterly valuation, and the pension, our US pensions, our global pensions, the sovereign wealth funds, they're all basically defined benefit pension plans. They have bought into the quarterly valuation. You know, they probably like the stability. So that side is more about better quality than increased quantity. However, we are having conversations with defined contribution plans, and they are now, certain ones of them are allowed to invest in privates. And we are, you know, the first question out of their mouth is, you know, daily valuations. And we've done that on the private equity side for our clients. We're figuring out how to do it on the real estate side, but ultimately it drops off. You're trying to predict an income outcome. So it's drafting off of the, you know, the whole appraisal process. You know, that being said, the revolution that's happening in computer technology is not about new math. We know how to do daily valuations. It happens in the UK regularly and thoroughly. Sure, what it is about handling more and more data. And as that becomes more and more possible, and we're just going to see, you know, because you can, people will want it, and it will improve, you know, a lot of transparency on what is otherwise an opaque industry. And some of the things that people are building are just astonishing in terms of leveraging that technology for better valuations on the buy side. I don't, you know, somewhere along the line, the appraisal side is in a different place.
Well, and I totally agree. And I mean, I think that's the fascinating thing that is evolving, is that the industry has to meet investor requirements, the investors' risk teams requirements. And there's, from my view, there's just, when you talk to an asset allocator, an asset owner, there's just more people that are interested in what's going on in real estate. And so the managers are pushing up more information. The valuers are trying to grab more information, trying to be more consistent. So, you know, hopefully the industry uses this, kind of call it this era or whatever, as that impetus to make some of those changes. And we might not have a choice if investors are demanding it. So, yeah, so maybe Chris, over to you, just you know, some of the valuation system changes that you've had to help lead at North Point, and maybe what's changed over the years, right, as we've kind of gotten through this interest rate boost, etc.
That's great, James. And maybe to build on what Margaret has said, so we have, and I'm sure everyone has, multiple different, you know, clients, and they have different needs. And so, you know, generally you build to the highest spec, right? So, you know, you have, so more recently we've had, over the last several years, we've had clients who've had greater needs. And once you do that, you can then, at least you're given the option to institute those best practices down through the rest if they want, right? And some may not want that. So, you know, I think what Margaret's describing is somewhat of the bleeding edge, and it seems like it leans a little more, obviously, retail and with the DC plans, but we're not at all at the bleeding edge, but I like to think there's been an evolution inside that's probably sweeping industry-wide. And so, you know, the tide is rising, and so I think everybody is. And so I do think as we institute some of these newer procedures for some of our existing clients, it's very easy once you've built them to then just deploy them, you know, across everybody with almost limited additional costs.
Yeah, definitely. Yeah, I think that's right. And the system and capabilities, I would say one thing like we've noticed at Altus is many of our clients now have a data scientist as part of the team, and that data scientist is helping with X, they're helping with overall performance reporting and just getting really involved. There's no doubt that there is a lot of data, that cleanliness and the ability to take trends from that data, that's, I think, maybe the challenge. And, I think it'll be pushed forward by investors asking for more. Maybe we'll see things from other asset class type reporting like public equities where there's just a ton of data, there's algo trading, there's things like that, and we'll see how that affects. So kind of as we get towards the, we've got about 10, 15 minutes left, wanted to break out kind of the future view. And Margaret, what does the rest of the year look like? Is it, a emphasis on just watching the Fed? Are there other waves that you see from your experience? Like, okay, everyone, put on your seatbelt, buckle up kind of thing, because there's going to be volatility that maybe folks need to prepare for.
So it looks like we're getting towards the end of this inflationary cycle. It's getting under control, and hopefully that means interest rates are under control. It looks like we may just skirt the edge of a recession. We do invest globally, so there is recession in like Germany, and China's really struggling, I'll note. But as the outcomes become more clear, it is easier to underwrite. It will bring more people into the transaction fold and bring the volume back to have the price discovery that I know you're waiting for to mark these things to market. Yes. And also we'll note that there are tremendous funding gaps. Again, existing loans on paper are going to be replaced with loans that are half as big. Right? And that puts a lot of pressure on leveraged donors who also have pressure from the slowing income line issues, net income. And backing up, the banks are selling a lot of loans. They are managing this. This is not going to be fatal to them. And I want to set aside office, which is its own distinct issue.
Right, yes, yeah.
But the banks are selling loans. They're selling them to shops that are going to work to restructure and extend them, which is going to require pay downs. So, you need money to keep holding your asset there, and not everything is going to be savable. There were a lot of marginal deals that were good quality deals, but, a little bit too aggressive underwriting, a little bit too aggressive leveraging that are going to need to be sold by motivated sellers, whether it's the original owner who can't close the funding gap or somebody who has foreclosed. And we do think that's going to lead to some really interesting opportunity on the buy side. And so our kind of our pause is, it's not interesting enough yet, but all of the environmental factors are there for some pretty good buying times ahead. Big opportunity to recapitalize for managers who want to continue to own quality assets. They're, where the horse race is halfway run, and they kind of have a good sense of where it's going to end up. And then for the ones that can't be sold, just the whole non-core, value added and opportunistic is really set up for a great vintage year.
And as you referred to earlier, using retail as the base case for that ability the industry has to reinvent properties to make sure that they can meet the income needs, I think that's super important as well. So, okay, so maybe resetting of expectations of loan to values, reevaluating the access to capital, who the capital source is, and then on some of these distressed investments, the willingness of maybe someone in that borrowing stack that is a motivated seller or pushing the seller to reevaluate. Adam, what about you? What's your views? Obviously, you have a lot of experience in residential. Do you see green shoots, more allocation maybe to private real estate in light of what Margaret's kind of insinuated around? There seems to be a swell of investors that are, monitoring.
Yeah, there are a swell of investors because real estate is an attractive investment, and people have real estate, which is why you've seen more and higher allocation to real estate from institutional investors, pension funds over the last 10 years. And I agree with her. I think there's going to be tremendous buying opportunities, or for people who want to recapitalize those as well. We're seeing the debt maturities is a big deal. So while the rest of this year may be pretty slow, I think hopefully as we're going to see debt start to stabilize, which helps with understanding pricing. But if we've got about $250 billion a year of debt maturities per year over the next few years, coupled with record levels of supply, over these next couple of years. We think there's going to be tremendous buying opportunity in the Greek market, especially in spaces like value add, opportunistic. So we're actually really excited for being able to deploy significant amounts of capital over the next couple of years.
Could you just elaborate? You mentioned increase in supply. That's specific to residential, right? And is that specific to the region, or
strictly multi-family?
I'm just making sure. Yeah, no, just want to because I think that's interesting. So because in many areas there's like housing shortages and there's not supply issues, but what's
there are, if you look at what kind of the future supply graph in a lot of these markets, there's a lot of supply coming in for the development side that's going to be delivering units here over the next couple of years, and that's coming right along the same time as a lot of these debt maturities coming due. So I do think, from the valuation side and the obvious index, we're going to continue to see that get closer to the real pricing. So I expect to see a decent drop in the overall valuation of the Odyssey. And then I think we're going to see people really kind of coming in and buying again, people coming back into open-ended funds as they get repriced to a place where they're comfortable. And you'll see a lot more capital being deployed because there still is a lot of dry powder out there. There's a lot of investors with a lot of money just kind of sitting and waiting for what's the right time, ourselves included.
Right. Yeah. And your partners, and I think that's right. The the view on dry powder, the view on just a reset of expectations. So thanks for clarifying that. And how about Chris? What about you in terms of what's going to move things to maybe a growth mindset again, as a technology solution, rates staying stable, lower, investors resetting their expectations?
Sure. Well, for us, and if we can pull up that little graph, I mean, perhaps just it is a forward. I mean, it's a forward-looking graph to some extent. So for us, I mean, there have been two big thematics, at least at the U.S. government level. And again, just as Adam was talking about multifamily, I'm talking about industrial here, and pretty much only industrial. There have been two big acts. One of them is the Inflation Reduction Act, which really was among the several things it was trying to do. It was trying to help climate change initiatives. And so rooftop solar is something that we've been hoping for and planning for. We've been building the capabilities into our buildings for 2-3 years now. That's something that and no worries if it doesn't come, but it would show a significant. This can be the impact of the Inflation Reduction Act and also the CHIPS Act, two what we think are fairly important and developments over the last fairly recently that have not yet been felt. And so Inflation Reduction Act will allow for significant rooftop solar. Pretty much 160 million square feet of our roofs don't yet have rooftop solar, but we're aiming to sort of remedy that in the coming near term. Here we are. And so that's one impact. But then the CHIPS Act is starting to really increase some of the manufacturing spending. So there's been talk of this for many years, and we believe that the impact of this is yet to be fully felt, because as the facilities are built, and it takes time to build them, there will need to be an ecosystem that supports them. So similar to the consumer-driven deliveries that have been playing for a while. So we think that's going to be interesting probably for the U.S. economy as a whole, but also, specifically to more or less what we do, which is larger form parks that lean a little bit toward this manufacturing. So for us, we're fairly excited about that going forward.
Yeah, well, two big injections of capital, or maybe kind of the markets weren't there. I mean, Chris, I think all you have to do is figure out how to build high-tech semiconductors in old office buildings, and you'll be all set. You'll solve the office problem, and you'll have lots of new warehouse space.
We do a little bit of multifamily. We have done some conversions of multifamily from office to multifamily, and they're hard to do. we can tell you that they're very hard to do. We feel like we did it with success, but we're not in a rush to do a lot more of it.
We could have a whole webinar just on that. But let's at least hope that commodity prices stay under control. Personally, I always watch the price of gas, because I think that dictates a lot of what goes on in the economy. So look, we're in the last couple of minutes of this webinar. This has been amazing in terms of the amount of learning, the insights. I always like to kind of give the speakers to just talk a little bit about something that's personal to them or to their firm. And so Margaret, for you at StepStone, is there anything that you could wow our listeners with, or something that's been for you a personally important project?
I've been working for the last year or so on our twice a year house views, which is really a compendium of all the knowledge across the, getting close to 100 people, broadly speaking, on our team that are operating globally across the risk spectrum. We had over 800 meetings with GPs last year. And as I said, directly underwrote transactions to deploy $2 billion in the co-investments and secondaries, which is less than 2% of our pipeline, by the way. We're super selective. So we're really working to bring all of that knowledge plus, a review of the market research and an analysis of data to our clients twice a year to really help them as we work to not only capitalize on things like the recap and the non-core opportunity, but also do it in the most interesting property types and locations. So really trying to leverage all that to hone how we're allocating dollars for better results. And that is we've got other things on the drawing board, not ready to talk about, but Stepstone has a huge commitment to proprietary technology. And that is continuing to advance, and there will be more and more things that we have available to our investors. Both advisory and discretionary. So we've got a lot going on.
Yeah, it sounds amazing, and certainly the can tell the excitement that you have to kind of solve some of these problems for your clients, right? Which is super important. And how about Adam? How about you, Fairfield? Anything that you want to tell us about that?
I think what's fun for us is we just launched our first open-end fund. It's an affordable housing fund, specifically kind of focused on tax credit, which is an exciting opportunity for us. Continuing to load our dry capital for value add and our next fund series there. But we spent a lot of time on technology as well, kind of implementing new BI solutions of dashboards, integrating our own operating analytics with third-party market research. And we're also building a new investor portal right now to kind of be a better experience for them for both their document management, but just more real-time insight into what they own and what the performance is in a dashboard setting. So we're excited about that too.
Okay, so both Stepstone and Fairfield gearing up for the future. And Chris, I have to say, I love the URL for your company's website. It's called beyondthecontract.com, and sends a good message. Tell us about the culture there at North Point, because I think you guys are doing something really special, both with your product and then it sounds like on the people and culture side too.
Yeah, so it feels like it. So our founder and pretty much all the senior execs are very big fans of Warren Buffett and kind of live that Midwestern values. And so I think the idea is, listen, especially doing the way we've done it, which is to assemble and do and kind of, do a lot of that with joint venture partners. There's no way a contract is going to contemplate all that happens. And so I think the view, and I know the view has been to try to find a few partners you can work through to kind of, as the bumps occur, you kind of trust the partners. And I think there's a saying, and I don't know which way it goes, but maybe it just goes both ways, which is you can't write a good contract with a bad partner, but you also can't write a bad contract with a good partner, right? So I think for us, I just think we've aimed, or the organization has aimed to kind of try to find, what can be true partners, both ways, of course. And surely that trickles down to kind of the core values of the organization, treating people right, and the other things that kind of stem from trying to be the partner that we would hope to find.
Okay, so that's great. And so if you're all Buffett fans, we'll have to send some cherry Cokes and a bunch of hamburgers down for you guys for your next team meeting. And listen, this has been tremendous. I can't thank you three enough, Margaret, Adam, Chris, tremendous amount of knowledge. I would say to our listeners, if you have questions, please reach out to Altus. We can connect you with the speakers. Tune into our other podcasts, webcasts, keep learning. And of course, a quick shout out to my Altus colleagues who kept us organized to get this off the ground. Hillary, Gemma, Kat, Adam, the Altus field marketing and offer marketing teams, thank you. And so with that, there's our final closing remarks. And I'll just say again, thank you to the panelists, and really enjoyed today's conversation, and good luck with the rest of the year. We've got debt maturities to contend with. We've got investors, dry powder, all these exciting things. So have a